Good morning. I'm Jen Amos at Weiss Research.
I'm Andy Myers, and this is your morning market update for Wednesday, November 23rd. Stocks on Wall Street are in negative territory again, threatening to make it 6 straight losing sessions heading into the Thanksgiving holiday. Trading volume is likely to be extremely light today. All the U.S. asset markets are closed tomorrow, and the stock exchanges will close early on Friday. Because of the holiday-shortened week, we've got a lot of data packed into today's economic calendar. First up is some disappointing news on consumer spending. It rose just 0.1% last month, well below the level forecast by economists. Many Americans instead decided to save their money, pushing the personal income rate up 0.4%, its biggest increase since March. The readings are a big turnaround from September, when spending jumped by 0.7% and income ticked up just slightly. The October report is a troubling sign for the U.S. economy because consumer spending accounts for as much as 2/3 of economic activity. Meanwhile, a key inflation gauge within the report showed that price pressures remain within the Federal Reserve's target range.
A separate report showed that orders for durable goods fell 0.7% in October, their second straight monthly decline. The drop was largely due to weaker demand for commercial aircraft, but orders for electrical equipment and computers also fell. And demand in the closely watched core capital goods segment, which does not include the defense and transportation sectors, dropped 1.8% after 2 straight strong increases. However, on the plus side, economists had expected a much bigger decline of 1.5% in the top line number. And excluding the volatile transportation sector, durable goods orders actually rose by 0.7%. Auto sales continued to be a bright spot, jumping 6.2%. Meanwhile, 393,000 Americans filed for first-time jobless benefits last week, an increase of 2,000 from the upwardly revised level the previous week. Economists had expected a slightly lower number of jobless claims, but the figure is still almost 6% below where it was a year ago. Plus, the 4-week average, a more accurate gauge of employment trends, declined to below 395,000, its lowest level since early April. Economists say that the number will have to remain below 400,000 for an extended period of time to indicate a healthy pace of hiring.
It's not just U.S. economic data that's moving the markets today. Markets' preliminary reading of manufacturing in the Eurozone showed a slight improvement last month over September's level, but the sector is still contracting, underlining concerns about a possible recession in the region. Meanwhile, manufacturing in China seems to be slowing much more than forecast this month. HSBC's preliminary Purchasing Managers Index for November came in at a level of 49. Any number below 50 indicates contraction. Economists had been expecting China's manufacturing sector to keep expanding at a very slow pace. The disappointing data is causing investors to move out of assets perceived as relatively risky. That's leading to broad declines across the global equity markets, but it's also weighing on commodity prices. Right now, crude oil is dropping nearly $2 a barrel, trading just above the $96 mark. And even gold, which is usually seen as a safe haven, is slipping below $1,700 an ounce.
We're also seeing some big moves in the currency markets. The euro is falling to $1.34 against the greenback on continued concerns about the ability of European leaders to tackle the sovereign debt crisis. A Belgian newspaper reported that the bailout plan for the troubled lender Dexia is proving to be unworkable. Belgium is reportedly asking France to shoulder more of the costs. Those two countries and Luxembourg previously agreed to finance the rescue of Dexia among themselves. However, any renegotiation would put France's government debt in even greater risk of a downgrade. Fitch Ratings warned earlier this week that the Eurozone's second largest economy could lose its AAA rating if the debt crisis spreads further. The report on Dexia is driving the yields on French and Belgian government bonds sharply higher, along with Spanish and Italian borrowing costs. And bond investors are even questioning the health of Europe's biggest and strongest economy, Germany. An auction of German debt technically failed this morning, with less than 2/3 of the 6 billion euros in 10-year bonds attracting bids. That's the latest from Weiss Research. Have a great trading day and a very happy Thanksgiving. We'll see you back here on Monday.